Hey everybody, Carl from daytradetowin.com here. So today we're going to continue the series of short but powerful video lectures on day trading using price action. We will also produce longer, more detailed and thorough videos for you, but I want to introduce the topics in short and simple videos first. So last time I told you about how I came in contact with day trading using price action and how I became successful with technical analysis, price action some 25 years ago. There are many topics in the field of price action that we'll need to go through one by one, but today I want to focus our attention to trends. I don't know if this is the obvious topic to start with, it might not be, but at the end of the day, trends are going to be the thing that makes you the money in trading. So I think it's a good choice of topic to begin with. So if you look at the chart, whether it's a candlestick chart, whether it's a line chart, whether it's a open, high, low, close chart, regardless of the type of chart you're looking at, you'll see that the market always moves in waves. It doesn't matter if you chart the S&P 500 like we do here. It doesn't matter if you chart futures, commodities, currencies, or stocks. You will see that the price goes up for a while, then down, and then starts moving up again. And that kind of movement continues all day, every day. And it doesn't matter if you look at a minute chart, it doesn't matter if you look at a 5-minute chart, an hourly chart, you can even analyze daily charts, weekly charts. They will all look the same, they will all act the same. So if you look at a daily chart, for example, here, you will have these up and down waves. You can look at a hourly chart. Each bar here represents 1 hour. You'll have these same up and down moves. You can look at a weekly chart. You will have the same type of waves here. So if I go back to the 5-minute chart here, so they will all look and act more or less the same. Sure, there will be some differences, but the cool thing about price action is that once you learn it, you can apply your knowledge from the most minute intraday charts to long-term charts, daily, weekly, or even monthly charts. So in this series, you're going to learn principles that apply to all markets, all time frames, so that's pretty cool. Now, I have been an equity options trader at an American trading firm. I've been a private day trader. I've been a swing trader. I've been an investor, and I have used the same knowledge, the same techniques, same principles all the time for the past 25 years. So what you're going to learn in this series is truly universal. It's not something that will work sometimes on some specific stock or some specific futures contract. This will be universal principles that you're going to learn. The market here moves in waves. It goes up for a while, then down, then up again. So I call these up waves and down waves. I don't know if that's the correct terminology, but that's at least the words that I use. I tend to use my own words, keep things simple, so I don't care if this is a XYZ uptrend or this is a mini bang down move. I don't care about that. I use my own words. Anyway, sometimes the market moves upwards longer and with more force, more power than when it's moving downwards, and then it just moves down a little bit when it turns into a down wave. And when that happens during more and more of these up waves and down waves, this price action will form a uptrend. So in this case, you have a trend from here to here if we disregard these minor swings here. So each up wave here is another leg in the trend in the same direction. We had this move and this move, 2 up legs here, and the market reaches this level. So the trend is still up even if you have this short-term down move right here. The main trend is still upwards. Here the market is just experiencing a pullback, a down wave. Could even be a few down waves during an uptrend, that doesn't matter, back to back, but you can say that the chart is battleground between buyers and sellers, between bulls and bears. So if the bulls are winning the battle, then the market moves upwards. If the bears are winning the battle, the market will move downwards. So when the bulls are winning, an uptrend is formed. And we will go through this battle between the bulls and bears in a later video. There's pretty cool nerdy information about that also that I want to share with you. So in the uptrend, the bulls are winning the battle, but the war will continue, that's for sure. And that means if the bears start winning, you will get a downtrend. You will have the same principles at play in downtrends. The down waves are going to be bigger and stronger than the up waves. So this time the trend will be downwards. So in other words, when you have a series of stronger up waves or stronger down waves, the market will establish a trend. If the trend is downwards, you can have up waves forming rallies upwards, but as long as the major trend is downwards, meaning stronger down waves, those rallies will fade and the market will reverse and continue downwards. So if the bears are more and stronger than the bulls, you will have a downtrend. And at some point, all trends are going to end. And when that happens, sometimes the market will just consolidate and move sideways for a while. That means you can also have sideways trends where the up waves and down waves are similar in size, similar in force, where you can have two small down waves and one big up wave, or a few smaller up waves and then a big down wave. The market can continue like that in a channel, in a sideways channel. So each up move, each down move, they would take each other out in a sideways market. So it's a tide between bulls and bears. And in Wyckoff theory, these sideways channels are called areas of accumulation or areas of distribution. And that means that either the buyers are accumulating their positions, they're buying stocks or they're buying contracts that they want to sell later at a profit, or sellers are distributing their holdings that they bought earlier. So these are ideas and methods developed by Richard D. Wyckoff, sometimes in the 1920s, 1930s. And that has been a foundation in my analysis and my trading. So I will also go through more of the Wyckoff method in this series. Anyway, the great thing about uptrends, downtrends, or sideways trends is that you can profit regardless of the direction that the market is going. And as we move forward in this series, you will learn techniques to use in uptrends, techniques to use in downtrends, and techniques to use in sideways markets. So this was the first lecture on trends. Next time we'll have a look at a little bit more advanced trend analysis, and I will introduce some ideas how you can gauge and measure the force of the trends, how you can determine if the trend is healthy, if it's likely to continue, or if the trend appears to be reversing soon. So guys, please subscribe to get access to the next video, and I'd love to hear comments and feedback on this series, so please comment and like the videos, and make sure you subscribe to our YouTube channel. Our next membership program starts soon, so please visit our website daytradetowin.com to learn more and check out our software. Our strategies are based on price action. So until next time, take care, bye bye.